And hello again. Welcome to Tuesdays with Lloyd's. I'm your U.S. Market Development host, Pat Talley. Before we start, we always like to take a moment to share any recent news or developments from Lloyd's that we think the audience might find interesting. We were very pleased to report that on June 3rd, Lloyd's and managing agent Apollo announced the launch of the first captive syndicate formed under Lloyd's revised syndicate model. Lloyd's commercial director, Don Miller, said, quote, "We are delighted to welcome Captive Syndicate 1100, which is the first syndicate to be launched under Lloyd's revised captive syndicate model. We look forward to welcoming further businesses to our captive platform in the near future," end quote. Perhaps most notably, a Lloyd's captive syndicate can insure its parent in over 80 countries around the world on a direct basis from London without the need for a fronting company. If you or a colleague would like to learn more about Lloyd's as an attractive alternative to traditional captive domiciles, feel free to drop me a note at pat.talley@lloyds.com. Now back to today's program. In keeping with our 2024 theme of innovation, today we'll focus on an initiative Lloyd's launched specifically to promote new and innovative business within the market. On June 1st, 2020, Lloyd's launched the Innovation ICX class of business, designed to help underwriters undertake innovation experiments without having to compete internally for capacity or having it any impact on their performance-based oversight. We're joined today by two experts from the Apollo Syndicate to help us understand more about ICX and what Apollo is doing to commercially capitalize on this. Joining us from Apollo are Hayley Budd, Innovation Class Leader at Apollo's ibott 1971 Syndicate, and Shimin Liu, Pricing Actuary with ibott 1971. Before we begin, just a reminder that we do encourage you to ask questions of our panel during the session using the Q&A tool. We'll save some time at the session at the end to address as many of those as we can. So with no further delay, Hayley, Shimin, welcome to Tuesdays with Lloyd's, and let's jump right in. Hayley, tell us more about ICX. I mean, just what it is and how it can be used.
Sure, thanks, Pat. So ICX, we love an acronym in insurance and the Lloyd's market, but it's Innovation Class X. It's a syndicate class of business. It's important to say that it is a class of business and not a risk code. I think that's one of the common confusions that we see with it. Most risk codes can be written under the ICX class. And as you said in your introduction, it is one of the ways that Lloyd's are supporting innovation. And it gives us syndicates what is effectively a sandbox for us to support innovative products or solutions without fear that it's going to impact on our syndicate's performance elsewhere. If, as innovation, there are a lot of unknowns, it doesn't perform as we would expect. Most syndicates can use ICX. You just have to include it within your business plan that you would submit to Lloyd's every year, or you can update your plan partway through the year to include it. It now gives you 5% of your syndicate business forecast, your business plan, to put towards innovation initiatives. Previously, it was 2%, but it's now been more than doubled recently, given the interest and use of the class. Now, Lloyd's doesn't define innovation. It doesn't tell you exactly what you can put into it or how you should think about innovation, as every syndicate's definition of innovation is going to differ to the next. Lloyd's more gives you guidelines, and I would thoroughly recommend that people do read the Lloyd's ICX guidance, as it is very useful in explaining what the class is and how it can be used. But you can use ICX to write risks that leverage new data sets, that use new technologies, that are using new distribution, for example, digital platforms, new structures like parametric risk, could be new ways of handling claims. Perhaps you're leveraging satellite imagery to assess losses after a NatCat event, or you can use it for other innovative underwriting initiatives that you might hear a lot about smart follow coming out of the Lloyd's market. So that's another thing that you could use your ICX capacity for. And the last thing I would say you use it for, of course, is for new innovative products.
So I like the way you said it's a sort of a sandbox or a bonus basket where you can experiment with certain ideas, but with no repercussions to the rest of your business.
Exactly, exactly. And it doesn't mean you still shouldn't have the same amount of oversight that you'd have over any risk. It's just that Lloyd's appreciate that there are unknowns with innovation, so they give you a spot where you can experiment with it safely.
It's also interesting to note that, yeah, I guess innovation means different things to different people. So it's sort of however you define it within these broad guidelines.
Exactly that. Yeah.
Well, is there any sort of business that's restricted or you cannot place within the ICX class?
So there are some restrictions on certain risk codes. So there are franchise restrictions on some risk codes. So CR, which is credit risk, FG, financial guarantee, CY, which is cyber. There's some others for surety. So you can't automatically write those risk codes using ICX. So you would need to speak to your syndicate performance manager and get approval before you can place any business using those codes. More generally, you can't put business in there that's already materially supported or established at Lloyd's when there's not another innovation angle just because you want to start writing the class. So with the example of US windstorm, you can't put it into ICX unless there's another innovative element to the product. So for example, you're structuring it as a parametric risk. The next thing is you can't take things that you've been supporting in your syndicate again as an established class, and then you want to move it into ICX to get the benefits on the capital relief that you get at Lloyd's for certain business, and also the performance related parts. So if you've been writing cyber for 10 years, you can't just decide you're going to lift it and shift it into ICX unless you have another form of innovation on the product that warrants it. And then I would say the last thing here is that you can't use it to support products that are subject to minor tweaks. So small wording changes, like you've put in a new exclusion or you've extended coverage in a certain way that isn't new and innovative product.
Okay, so it's pretty buttoned down exactly. So to make sure that it specifically fits this template. Okay, excellent.
Yeah.
So let's just specifically as it relates to Apollo. How does Apollo? How are you using ICX?
So for us, we're focused on the new products element. So new products that aren't materially serviced by the Lloyd's market at the moment. Products that are aimed at filling a protection gap. We do that via a consortium arrangement. And what that means is that Apollo will take a lead line on innovation business, and then we have other syndicates that sit behind us in a follow basis, which is fully delegated. And we leverage a consortium simply because when we were speaking to our clients, and we've been using ICX since I think 2022, when at the time when it was 2% of our allowances, Syndicate 1971, being able to give 2 million, 5 million limits wasn't enough for clients to be able to solve the problems that they were trying to solve through innovation. So by pooling our capacity with other syndicates, we're really going back to what is the bedrock of Lloyd's in pooling that capacity. And it means that we can bring more limit, more capacity to our clients to solve their problems.
Okay. So as you develop and build these innovative new products, are there specific like key principles or rules of the road that you strive to live by?
Of course, I know a lot of people say this when talking about innovation or just any business really, but we really do strive for true partnerships when we're trying to launch innovative products. Anybody who has tried to do innovation or is involved in innovation will know that it's really, really difficult. It's definitely a team sport. You're working with a lot of unknowns. I think you have to be really open, you have to be transparent, you have to have a lot of trust in your partnership with both sides, willing to share information and data. Innovation, when you're building new products, requires you to be really nimble, be able to tweak your product or your pricing. So if we have somebody who's just out there looking for quick capacity, will come to us and they want to stand up a product by next Friday, then they don't want to share data with you and they only want to talk to you once a year at renewal. It's not going to be something for us. I'd say at Apollo, we really struggle with the fail fast, learn fast mentality that you hear a lot about in innovation.
Sure.
Of course, everything we do is going to generate a ton of learnings. Like there's always going to be the learnings that come out of that. But we really like to take our time and make sure that we are placing well-informed bets so that we can support clients and products over the long term. We don't think spreading your bets on lots and lots of different products and then canning a bunch of those after a year or two is supporting sustainable innovation for clients. It's not helpful. One thing we haven't mentioned yet is that things have to graduate out of the ICX class. You can't keep them there forever. And we want things to graduate. We want them to be successful. We're trying to build insurance verticals of the future, which is what we've done within ibott 1971 with the sharing economy.
That's a great point you make. So is there are there any guidelines on when there's an expectation that something has to graduate out of that class?
So again, the Lloyd's guidelines aren't that prescriptive, I think, because with innovation and depending on the product, you're always working in market cycles. So a product is going to have a different cycle. Some they're going to bear out very quickly, maybe 1 or 2 years. Others may take 5 years. I think that would probably be around the maximum. But I think for something to graduate, you're going to need a few things. One is duration. One is going to be premium income. So if you're working with MGAs and you've launched an innovative MGA, you need to prove that there is income. People are purchasing the product. Quite often when you're launching new products, they might take a while to get off the ground. You're also going to need to build up through that time some experience data. I think we'll talk about that shortly. So having that period of time where you can start to get experience data that means you're able to tweak the product. And then I think there's also an element of just operational maturity as well with companies that you're working with, so that everything is running as well as it should do. Operations are slick, things like bordereau reporting, you're getting it on time and it's accurate every month. So I think there's lots of different markers. Lloyds don't necessarily define them. I think it's for each syndicate to define that. And everybody will have their own definition of what graduation looks like.
Sure, sure. Well, so now we've sort of got the theory laid out. So can you give us some real world examples of the type of businesses or businesses that Apollo has used the ICX class for?
Yeah, there's been quite a mix, I would say, a few that we've supported. So one is a first of its kind insurance in the UK. It's a parental leave product. It's called Just Parent. Shimin will talk about that one a bit more. We have a first party trade secrets product, which is written through an MGA called Crown Jewel. And this is where if you have trade secrets, and they are misappropriated, so maybe a member of staff leaves, they're a bit disgruntled, they start telling everybody about your secret recipe, and then you suffer a financial loss as a result, then this policy would kick in. So that insurance hasn't existed before. And then the last example I'd give is a parametric cloud outage product. So it's like a business interruption product for those who are reliant on cloud services. And that one we write for an MGA called Parametrics with an X. Not everything we will do in the future is necessarily going to be through an MGA. It's just been quite heavy on that front to date, I would say.
So very, very practical products. I mean, business interruption for the cloud going down. I mean, I guess it's a specific trigger for duration or severity, and then it triggers the program.
Yeah, so one, like if you're reliant on cloud, say you're a booking company and your revenue is all online through sales, and your cloud provider, whoever that may be, goes down for a few hours, like that could result in a lot of revenue being lost for some companies, especially at peak times. Like if that goes down at 5 p.m. on a Friday, you're a travel booking site, and that's when people are like, it's been a long week, I'm going to book a holiday, and your site goes down. Whereas traditional cyber policies may not kick in until a 12-hour waiting period. This kicks in much earlier, kind of like after an hour, 2 hours, and it's for specific services that you are reliant on for your business.
Wow, when you think about that, it looks like the possibilities are endless, the ways you can move this around and make it applicable. Well, let's go. This is one thing, and I think this interests a lot of people. Whenever you have something completely new and novel, uh, you know, it seems like almost necessarily you would not have the experience or claims data to help with the pricing. So, we hear this just in casual conversation. How do you price celebrity body parts or Lloyd's or whatever, things like that. So in those cases, how do you price that risk, the new risk?
Yeah, it's a question that we get asked a lot as well, and you're absolutely right. What do you do when you don't have that loss experience data in hand? With some of our products, we might be lucky to have a little bit of experience data. Either they've done a pilot or they've been operating for some years, or they're a type of risk that is similar enough to another product that we write through Core 1971. We can leverage that, those benchmark data, and kind of adjust the benchmark rating to suit the new risk that we're looking at. So looking at, the mix of business and how that differs to the one that we're actually pricing. Usually we don't, especially when that product is brand new. There is no specific loss experience data to do a traditional burning cost analysis with. So the one that Hayley just touched on with parametrics didn't have, specific loss experience data for that product, but it did have decades of cloud outage data, and sort of the durations of those outages that hasn't been collected for an insurance context, but you could use that to really understand what the drivers of claims frequency and severity are coming from, and then build a product sort of around that. That's one example. Another example we have is with Just Parent, which Hayley also mentioned, which is our parental leave product that we launched earlier this year. How that product works is sort of a balance sheet protection for sort of small, medium-sized businesses to help them offer more parental leave to mothers and fathers within their payroll. So when a mother or father decides to go out on leave, the employer can cover the full salary of that employee whilst they're out of leave. So we don't have the loss experience data for that product yet. So you have to really start thinking creatively about what alternative data sets that there are, so you can inform the likelihood of an employee going out and what length of time that they're out for, to kind of inform the severity of that loss. And yeah, for Just Parent, it was the national birth rate statistics for age and gender from the ONS. So we really kind of leveraged on that data, and you could see from that the birth rates for women in a specific age band are higher than in other age bands, and the same for men. So for men, the birth rates are higher for older ages. So once we understand what the data is kind of telling us, that helps to inform what rating factors we would need in the pricing model to sort of decide on where the riskiest parts of the portfolio would be. And so we realized that yes, age and gender are some of the driving factors for Just Parent, and that became the two main rating factors for it. It's also really important, I think, to understand the coverage and the target risks when you are pricing. So thinking about, what are you trying to cover? When will that loss occur? Like, who are you covering? We were targeting a higher skilled workforce with this product. So it was intended to be towards the more white collar industries, I would say. So you could make an initial hypothesis that birth rate distributions follow a different shape than the national average birth rates that we collected from the ONS. It might be that the birth rates are higher for older ages than for a national average. And so we had to think about whether or not we had to adjust the birth rates that we collected to fit in with the risk that we were rating. I mean, that data set can be quite difficult to find, but you then start looking at proxies. So is there a specific territory that is more closely related to the target workforce that we were going for? And you could see, yes, London versus non-London has different sort of birth rate distributions. And then it's really about testing those assumptions over time. There might be some assumptions that we just cannot get any data for, really. And one of them, for just parent, it could be the take-up rate of the available leave week benefits. So an employee might be given 26 weeks of leave. Actually, how long they decide to take is a bit of an unknown and an uncertain assumption. So we can make these sort of high-level assumptions and test those over time as we collect more data and sell more policies, and then be able to adjust that quickly throughout the course of the policy cycle to kind of refine the assumptions and the pricing model with that. And that's how we really started, even in core 1971 business, about 6 years ago, when we started writing rideshare, delivery, micromobility, vehicle leasing, and that's now our core business. And we've built some of the largest data sets from those classes in the industry, I'd like to say. And we're seeing that same for emerging risks like AV. So just kind of leveraging on the philosophy and the blueprint that we've seen from that business, which again is around collaboration and partnerships with the companies that we're working with.
It's fascinating that, so you just really early on, you really have to look at what other potential data sets are out there, what unknown correlation they may or may not have with what you're trying to do. And then of course, over time, it becomes much more solid and defensible and able to price. But those first years could be, I mean, a little scary, I'm sure.
Yeah, exactly. It's, even though there isn't loss experience data, we still want to work with companies and with concepts or products that have some sort of data, so we can take a data-driven approach to both the underwriting and the pricing. And the ability, I think, to be agile and work with different people. The pricing team and the data science team within 1971 are deeply embedded in the underwriting function, so that we can learn quickly and refine the model quickly. And that just goes not just for actuarial underwriting, but also to claims. So seeing what claims are coming through and how that might change the wordings and the pricing even further.
It's fascinating to me. And this is from someone who has been challenged with math his whole life. So it's how you do that. It would be interesting to look over your shoulder and see what sort of, how this process works. Well, it looks like this is probably a good point. We have a couple questions, or at least one that's popped up. If you want to jump into, see if we can address this. Are you ready, Hayley?
Sure. Yep.
First question is potential moral hazard an issue with these classes of business?
Is this with some of the specific examples that we've given, like Just Parent, for example?
I suppose so, or yeah, or anything else that comes to mind where you might have some element of that.
Yeah, I mean, moral hazard is something that we consider with any business that we write, and innovation is going to be no different. And we're looking at why people would want to claim or why they would buy the product. Now, if we think about Just Parent in particular, we don't believe there is moral hazard there. And part of this is around where we pitch the product and exclusions and language that we have in place. So we're not selling Just Parent to like single people enterprises, to like micro companies where maybe it's just you and a couple of other people, where you would know if somebody is pregnant or planning on getting pregnant or is going to take leave and might try and buy the policy. as a way of kind of shoring up against that. So there's language in the policy that says that a pregnancy has to be more than 12 weeks progressed and you not having known about it. So you can't then buy the cover because somebody has already told you that, hey, I'm pregnant, or my partner's expecting a baby and we're planning on taking some leave. So we have things like that that will address the moral hazard. With things like the parametrics cloud outage product, it's one of the benefits of using parametric third-party independent data sources to verify a loss. So the insured doesn't have input into when that comes down, when the cloud is down, because we're not including things like miskeying or config issues from a client. It has to be that central cloud data center. So whether that's AWS or Google or Microsoft Azure is down, and it is a noted cloud outage. So parametrics have lots of technology that monitor it. So it will depend on the product, but we always do have an eye on moral hazard and trying to limit it. And it's one of the things that we will assess when we're underwriting and when we're pricing.
Excellent, excellent. Well, I'm mindful of the time, and it looks like we may have reached a good stopping point for today. So, Hayley, would you like to say anything else, or Shimin, before we close out in terms of the future or anything else about this class?
I'm always asked to predict the future. I would say that there's a couple of topics that we hear a lot about at the moment. So carbon, and Lloyd's has a focus on this as well, and ensuring the transition. So we've got ICX and now we've got TCX as well, which is transition class for you to put low carbon risks into that. The other thing that you can't go to any innovation event or insurance event without people talking about AI. So it's another thing that we are focused on, is what are the risks that are going to be created out of using AI, and how can we build meaningful insurance products that are going to help people with those risks. We would always say that one of the biggest opportunities we think that's out there is autonomy. So you'll always hear us piping up in that space.
Sounds like the future looks very busy.
Oh, it's very busy.
Well, look, Hayley, Shimin, thank you so much for joining us today and sharing your expertise. Really do appreciate that. And then that will do it for this edition of Tuesdays with Lloyd's. We hope you learned something today. I know that I did. Be sure and mark your calendars for our next installment of Tuesdays with Lloyd's on July 9th. When we'll be joined from a team from Hiscox to explore how the digital revolution is giving London the edge. As we close today's session, please take a moment to answer the survey questions that will appear in your browser. We greatly value your candid feedback in shaping our programming. We'd also love to hear from you on any other issues, including suggestions for future topics. Drop us a note anytime at usevents@lloyds.com. So until July 9th, let's keep staying connected. Take care and have a wonderful rest of your day.
Thank you very much.
Thank you very much.